Good afternoon, everybody. Thanks for joining us on this tech funding event we're running. My name is Paul Johnson. I'm a partner at Mills Reeve, and we have put together a panel consisting of two companies that have raised funding, three investors, and then one of my colleagues, Zickie, who does a lot of work in this sector. The format is going to be a brief introduction from the panel. We then have a number of questions that I'm going to ask the companies and the investors to get their views and to try and give everybody an overview as to how the companies decided on the funding they've obtained and how that process worked for them, and then some overview from the investors as to what's happening in the market and key aspects of funding from their perspective. We do have a chat function, and if anyone has any specific questions they'd like to raise, please send those through on the chat function. And what we'll do is we'll aim to have about 10 minutes at the end where I'll try and raise any questions subject to how the debate has gone, and then we will have a firm close at 1:30. So that's all from me, and I'd like first of all to ask Gav Winter from RapidSpike to introduce himself.
Yep, sure. So hi, I'm Gav Winter, CEO at RapidSpike. A little bit about me. My background's in performance engineering. I used to be a tester, and one day that testing got me into a position where I decided to start my own company, and I thought that'd be a really cool thing to do. And then it turned out over 12 years to end up to be 300 consultants strong, which was a bit crazy. And it was very much like almost like the thing I would say would be it's like you see someone in that position and you think, wow, look at them. It's like riding a lion. And you see that person and you go, wow, look at them. They're riding that thing. And you're just going, what? How did I get here? And how do I get off this lion? So it's one of those crazy things. But I'm now CEO of RapidSpike, and RapidSpike is a SaaS business, and we're looking to change the next generation of website monitoring, very customer focused. We're looking to make websites much faster, safer, and more reliable, using multiple tools that we've been building, and make the lives easier of support teams and security teams by giving them very impactful, actionable insights to fix problems very quickly. And yeah, so that's sort of me. So on to the next person.
Excellent. Matthew, can you give us an intro?
Of course, yeah, and thanks very much for having us as part of the session today. My name is Matthew Scullion, founder and CEO of a software company called Matillion. Our mission is to make the world's data useful. So hundreds, in fact, over 1,000 companies around the world, mostly large enterprises, use our software as part of the supply chain of analytics, AI, and machine learning to get all their data into one place, transform it from valuable but not yet useful ore into refined, shiny steel in terms of data, and then feed it into those use cases I mentioned. We were founded 2011, launched our data middleware software 2016. Since then, treble, double, roughly in terms of revenue. Today, we're a little north of 300 people. And in terms of raising money, the topic of today's conversation, of course, we've done 1 seed round, 4 institutional rounds, raising about $160 million. That's me. Thank you.
Brilliant. Thanks, Matthew. Richard?
Yeah. Hi, everyone. And first of all, thank you, Mills Reeve, for inviting me here this afternoon. My name is Richard Faulkner. I lead Silicon Valley Bank in the north and Scotland. I'm proud to say I'm a career corporate banker. I've been operating for around about 23 years, and excited to say that the last 13 years of which I've been supporting high growth companies in the tech space. So Silicon Valley Bank, it sounds made up, right? Not a bit of it. We're a 40-year-old Californian headquartered bank, niche bank, serving just the innovation economy. So we're laser focused on this space. We're NASDAQ listed. We've got a market cap today of $30 billion, and we've got nearly 40,000 clients globally that we serve. SVB isn't just a normal bank. We sit at the intersection of capital and the innovation economy, and our clients are truly changing the world in which we operate. It's a fabulous place to work, and we're really excited to be able to support these high growth companies. So with that, I'm going to hand over to Rob.
Cheers, Richard. Good afternoon, everybody. My name is Rob Johnston. I'm an investor director at BGF in their Yorkshire and North East team, where I've been working for the past 5 years, 6 years nearly now, supporting growth-oriented SMEs who are looking to raise funding and bring on board kind of supportive long-term investment partners to help them accelerate growth. In terms of our focus of investments at BGF, we're predominantly investing in owner-managed and family-owned businesses established across a broad range of sectors. So we do tech, but we also do manufacturing, consumer, leisure, retail, you name it. We've got investments in that sector. And I currently sit on the board of 3 of our investment companies, including 365 Response, which is an earlier stage tech business based in Wakefield, providing e-procurement and transport management software largely to public sector clients. Prior to BGF, pretty well-trodden route in terms of getting into investment, Big Four, chartered accountant, and then made the move across back in 2015, where I've been since. That's me, Paul.
Brilliant, thanks, Rob. Andy?
So I'm Andy Round, and I got into investments by finishing my PhD in biochemistry and actually starting a small biotech playing. So we went on raised sort of traditional routes, raised about 60 million over a number of years. Deals before actually working probably my 3rd or 4th kind of venture fund. So I've managed anything from EIF, EIB money, EIS money, VCT. I've done deals on balance sheets and also quoted funds. At Praetura, we're a relatively new entrant. I mean, we do the venture bits, we're about 2 years old now. We've got a portfolio of about 20 companies. We raised in the region of kind of 30 to 50 million a year, predominantly EIS. This year and next year, we'll probably change a little bit and try to sort of raise more sort of classic sort of institutional funds. But I suppose where we kind of fit in the market is probably that kind of interface where some of the traditional sort of VCT funds probably wouldn't do a deal because there's still a little bit more kind of inherent risk left. Those are the ones that we quite like. And we're particularly hands-on. I mean, we do everything from helping with the management team, doing the corporate finance piece and everything else. So we use a tag kind of more than money, but I think we actually believe it. Most of us have had kind of SME backgrounds before. And those are sort of the types of business that we kind of look for, ones that we can have a genuine impact rather than just the cash.
Brilliant, Andy. Thank you very much. Zickie, over to you.
Hi, thank you. Thank you to all the panelists for joining us for today. I really appreciate it. So I head up the venture capital and investments team at Mills Reeve. I've been working for the last 22 plus years in this sort of early stage and growth capital sector. I have a team of 14 lawyers who focus on investment deals, and we work with a wide variety of investors. Predominantly, we work with institutional fund investors, so helping them with their portfolio investments, portfolio management matters and exits, but we also help investors with their fund creation and fund structuring work as well. But we also work with other investors like large corporates who are corporate investing, family office funds, business angels and angel networks. On average, we do between 85 and 100 deals each year, and aggregate investment amounts that are raised for in those rounds are between 250 million and 350 million each year. So we've got a lot of experience on the EIS VCT stage, which Andy was just referring to, and we also work with people like BGF and SVB. We also work with the fast growth entrepreneurial businesses. So that's a slightly different engagement for us, where we'll help them from really early stage startup, getting them investment ready, helping them through all their sort of various pre-seed, seed and Series A and B, C and beyond fundraisings, but also on other things like commercial contracts and scaling up their workforce, scaling up their business, e.g. through acquisition, etc. And our focus is really on technology, life sciences and healthcare businesses, albeit we do investment work in other sectors, just not as much of it.
Brilliant, thanks, Zickie. So if we can ask our two companies first to give us an overview as to what the various funding options they considered as part of their growth. Gav, do you want to kick off?
Yeah, sure. So I've got a bit of a sort of, I can draw on two experiences really, because I've raised twice in my previous founded business and within RapidSpike. And when we started our RapidSpike specifically raise, we were looking at angel funding because we thought, that's what is going to be the right thing for us. And then the more that we looked at it, the more we thought, actually, we're probably going to want to raise again within 2 years. And going out and getting a number of angels or some more angels, it actually was quite difficult. And I suppose we then thought, right, well, my typical background was VCT. So I was like, right, well, let's go and look at venture funding. And I wasn't really that way. I'm no finance expert. What I would say is I'm trying to be a storyteller and tell a story about how we're going to succeed, but I'm not a finance or investment expert, but I have obviously had my eyes open to all of this. And yeah, we looked at the venture and then came across the EIS, SEIS for RapidSpike specifically. RapidSpike had been around a while, so it couldn't qualify for SEIS and had some investment funding from its original founders. So it was an EIS thing. And we felt that EIS was going to really suit us for the next 4 years, because we can make an original investment. And then obviously due to the rules of EIS, we can get another few, hopefully we'll have a capacity to get, 5 and then maybe another 5 and grow our ability to get money through into the company. So we did look at the angels, and it was I suppose the other consideration was, what are you going to get for your money? Because I didn't just want money, I wanted help to plug all the weak gaps and the problems that I have in my knowledge, especially around finance and marketing and all those kinds of things. And that was why we did have a number of VCs doing VCT. We looked at a couple of angels, but then we came across Praetura, which obviously Andy's a part of. And, obviously I didn't tell them this at the time, but as soon as I met them, I had no interest in using anybody else, just because they sort of got it. They got the business, they understood what we were trying to achieve, they felt the story, they understood a SaaS business as well. Like, they weren't asking me for EBITDA valuations, they were asking me as a SaaS company, will value you like a SaaS company. So that was really refreshing, because, we weren't going to make any profit at that, for a couple of years, because we're building something. So, so that it brings difficulties when people are trying to understand why would you invest in this thing that's not going to make a bit of money for the next couple of years. So that was really, really good for me. And it was, that they were the types of investment, and I really liked the angel. I met some really, really amazing angels, to name one, Gareth Healy, who was really helpful and really, was someone who has now continued to follow RapidSpike and likes our tweets and comments and things like that. So you do meet great angels out there, but it was just going to be the EIS route for us was about as much about the money, getting the money now, but about our future raises as well. So it suits us for the next, probably 5 years, I think. unless we have crazy growth, which is also hopeful.
Yeah, thanks, Gav. That's really, that gave us a good overview. Matthew?
Yeah, so what of the various funding options did we consider? I guess in answer to that, we've done several rounds so far at Matillion and been lucky and excited to be involved in each of those. A seed round and then 4 institutional rounds, and they give these letters, don't they, which don't actually mean too much in terms of comparison. It's just the sequence that you happen to do them in my view at least. For my seed round, I didn't really consider too many options, and I would now. I just didn't know much about much back then. I went to 3 of my former bosses from my prior career with a business plan that I'd knocked up at home and said, hey, I need £500,000 to set up this company. They've retrospectively told me that they thought that I probably didn't know much more about the business model than they did. And really they were backing me. And I think that's the lesson from that particular round, that in the very early days, you're as much backing the team and or the individual as you are any economics or product market fit. At the first institutional round, which was 4.1 million sterling, we account in dollars now, so I always refer to it as $5 million. I pursued 2 fairly similar potential pools of investment, both institutional, both venture investors. But essentially, this was US-based, West Coast venture capital or UK-based venture capital. This was, as I mentioned, going to be quite a small round at about $5 million. I did 3 pitches in Silicon Valley and everybody said no. And so I assumed that I was getting far beyond myself. I've retrospectively learned that particularly at an early stage, the rough rule of thumb is 10 pitches to 1 term sheet. You want 3 term sheets to get tension. And therefore I should have done 30 pitches and probably would have raised money on the West Coast. Having said that, I came back to the UK and met a wonderful company who I've never regretted partnering with called YFM, who are a VCT and back innovative business models. And they've been a great partner subsequently. From the B round onwards, we have in fact partnered with West Coast Silicon Valley VCs and really not thought about doing anything else. We're a high growth business burning money and will continue to do so for quite a long time. That if you're able to secure it, I think is the best type of investor, particularly since roughly 2/3 of our revenue comes from the US. We partnered with Scale and Sapphire at Series B, with Battery, as well as the existing investors pro-ratering at C, with Lightspeed at D. The one thing I will mention that I've learned from that process is different investors like different stages of the growth journey. And Andy alluded to this earlier. Scale, for instance, are a highly respected Silicon Valley investor and have backed companies like HubSpot and RingCentral and Box and many others. But they like earlier investments, Series A and Series B. Battery, Lightspeed, Sapphire are more flexible. They might back smaller companies, pre or early revenues through to pre-IPO rounds with multi-$100-million checks. And at my next round, I'll likely be looking for either companies like that or growth investors or crossover investors, a crossover investor being someone that invests pre-IPO but also looks to rebuy post-IPO. So they can all look the same from the outside. But we've been lucky to experience this and therefore learn that different investors have different preferred check sizes and stages of companies and things like that.
Thanks, Matthew. I think very interesting. What comes across is this knowledge of where to go and how it works, and I think that's one of the challenges, isn't it? Where you're busy in your business growing it. But very helpful for an overview there. Can I then go to the investors and ask them to give us an insight into, from the other side of the table, as to what qualities they're looking for when they're investing in these sorts of businesses? Should we same order as before if you want, or if people want to jump in? Richard, would you want to first go at that?
Yeah, great. Thanks, Paul. So I probably should qualify. We're ostensibly not investors. We do carry on that activity at certain levels, but essentially we're a commercial bank, so we're debt. But the principle of the question is the same. I would probably call out three things, especially if we're talking about early stage tech companies that might be burning. So as a banker, the first thing we'd always talk about is management. So that is the number one. We've got to be banking a management team that have, experiences maybe is very important, but there might be less of it at this early stage. And therefore it very much, we want to see capability within that management team. So for us, and certainly me personally speaking, that would be number one, management team. Secondly, Matthew's mentioned it, product market fit. It's much vaunted at the moment, but we do see a lot of business plans where we just don't get that. We just don't think that the product will get traction. So certainly, product market fit would be second on my list. And then because we are backing early stage companies and because we are a bank, we don't get the equity returns, we get debt returns. We very much, I would say leverage off the investor. So the third one for us would be, what is the investor syndicate? Are they good quality operators and have they got follow-on capital to see this through? Because the bank would not want to be the only provider of capital with, dare I say, sort of deep pockets. We want to be going in alongside an investor that can actually follow on. So there's no point being able to do the seed or the Series A if maybe they can't carry on, or get an investor syndicate together that can carry on and take that company further. So for me, Paul, that would be the three things we look at.
Yeah, thanks, Richard. Apologies for the investor tag. I'm talking generically, but it's good to pick up a lawyer on his language. Well done. Rob, could you give us an overview from BGF then?
Yeah, I mean, I want to repeat Richard's first point, which I imagine will be the first point for all of us in terms of the credibility of management team, but a slightly different spin on that from a BGF perspective is, as well as the credibility and experience which needs to be there to back an investment, it's also about alignment of interests with the management team and believing that we're entering a partnership and there's an appetite from both sides to work together throughout the journey. We're very much interested in supporting with more than money, as is SVB and Praetura, who are on this call. So if we don't feel we've got that alignment and kind of openness to wanting to work together, it's probably not a management team that's suited to BGF. So beyond that, kind of product market fit, size of the market, particularly for earlier stage businesses, and the competitive landscape are real key focuses for us at an early stage in terms of assessing new opportunities. If you've got a large market and kind of a weak competitive landscape, that's a big tick in the box in terms of getting your head around just how quickly a business can scale. And then finally, for me, it's how can you demonstrate commercial traction and I suppose proof points in terms of pipeline development, sales cycle, lead times. What are your routes to market? And just having a very cohesive, clear commercial strategy as to how you're going to take your products or service to markets. That would be the three things I would add on top of what Richard outlined earlier.
Thanks, Rob. And Andy, appreciate your third in line here. So we'll reverse the order next time around. But is there anything you wanted to add on that?
Not massively so, to be honest, Paul. I mean, for us, it's equally as important with everybody else as to team, their current makeup. Those first couple of meetings of how they interact with you, in a lot of cases and a lot of deals, and from doing them to getting to an exit. I've had relationships with management teams that have lasted 8, 9, 10, sort of 12 years. It is almost a marriage. You can pretty much pick up quite quickly the kind of cues as to whether you think you're actually going to get on with them or not. Yeah. As Rob said, and Richard, there's that kind of nuance of, are they going to take advice? How well are they going to work with you? That interest alignment piece. The interest alignment piece is interesting as well, particularly if you've got syndicated rounds, because I've done transactions where you may be quite nicely aligned in the early years, and things do tend to change over time. They're not particularly static. They're quite dynamic. I think Rob articulated really well that kind of momentum piece, but equally, particularly on a lot of the healthcare stuff I get involved in. I know we do more tech today, but particularly on the healthcare stuff, very much that kind of understanding what the kind of technical and commercial milestones are, which are directly relatable to sort of value increase in the business. Getting over those and really kind of where they are. I'm a bit of a stickler for having at least some form of unique position. I'm not a massive fan of just doing the same old thing in a similar sector again. So I'm a bit more of I'd rather see something that's kind of revolutionary as opposed to evolutionary. I want something that's kind of got a bit of I hate the term bleeding edge, but that's what probably excites me more than just another kind of me too that maybe is a little bit cheaper or a little bit different.
No, thanks, Andy. Zickie, you see a lot of different investors, and you do a lot of work with some of these different institutional investors. Is there anything else there that you pick up on across the board from those investors?
Yeah, I think the thing that we tend to see is those investors who've really done their research on the sort of investor that they want to work with are the ones that tend to have a more sort of successful outcome. I appreciate that in the early stages, companies just want to get some money in, they need to raise some money, but it's really important to understand the sorts of investors that you're targeting. Are they, we've already touched on this, are they investing at that level that you're looking for financing for? Because otherwise you may well be wasting your and their time. But also, do they have a particular sector focus that they're looking at? And are you in that sector? Otherwise, again, if you're approaching an investor that has a specific focus on healthcare, but actually you're in food or whatever, something else that doesn't have a crossover, then again you're wasting your time. The other thing is around looking at their track record. Have they recently raised money, in which case they need to deploy it, or are they at the end of their fund, in which case even though they may well be saying they're open for business, they might not necessarily be open for business and ready to fund. And also whether someone else mentioned it, deep pockets, but can they fund beyond this current round? Is that their normal approach? Do they have the funds to do that? Or are you effectively just raising one time from them, and then after that you've got to look for money elsewhere? And when you're sort of talking to prospective new investors and you explain that your existing investors aren't following on for whatever reason, that obviously can have some sort of negative connotations.
How Zickie, and this isn't a plug for Mills and Reeve at all, even if it sounds, but if you're not in that world and you don't have that level of detailed information that you've got from doing it, what's the easiest way to try and get that? Is it just what's your view on that?
I think there's a variety of ways. I mean, you can try the direct approach. You can ask them those questions, and they will no doubt tell you where in their sort of fundraising cycle or fund cycle they are. You can do some research just generally, because fund managers like to publicize the fact when they've successfully done a fundraise and raised a new fund. So you can do that research. And then I would use your networks, because you will have advisors in your networks who will be in this sector and should be able to let you know if they know whether a particular fund manager has raised funds and is deploying, how active they are in the market. You can look at the fund's website. What are their portfolio companies like? How many have they got? How recently have those portfolio companies raised money? That kind of thing.
Fine, very good. Thank you for that. So back to the companies then. It looks like certainly you've both been pleased with the funding you've got. If you were, what lessons do you think you've learned from that funding process that you've been through that would be useful for the audience to to learn from. But appreciate that's a general question, but I'm sure you'll have some specifics in the process that you can bring out. Do we want to, Matthew, do you want to go first?
Yeah, sure, Paul. And so many lessons. Having said that, looking back on our cap table, there's no investor that I'm not delighted to have part of the team. All that being said, just very quickly, in terms of lessons, I'd say the most important thing is who you are partnering with, the cultural fit and shared values. It's a hackneyed joke, but most investment relationships last longer than the average marriage. So, and it really can tank your company if the investor's intentions are not aligned with your intentions. So that'd be thing number one, like cultural and values fit. I think when it comes to a fundraising time, like work hard is probably a good tip to any entrepreneur. I mentioned it earlier, particularly at the early stage. It's possible that you won't have investors inbounding you, and there's more reasons to say no than yes, many of which aren't to do with your company. It could be the fund's tapped out for that time, they've already got an investment in competitive space. The partner writing the check just doesn't like your haircut, right? There's more reasons to say no than yes. So particularly in the early rounds, like pitch a lot of people and get really good at the pitch, and pitch the ones that you don't want to invest first, so you get good at it. Get them to help you refine the pitch. And then by the time you get to ones you really do want to invest, hopefully you'll be better at it. The final thing I'd say is consider why you're raising money. I'm lucky and really enjoy nowadays working with some other entrepreneurs and CEOs building great businesses, sharing what we've learned both on operations and on fundraising. One thing I notice is that a lot of people have talked to me, the goal is to raise money, and that's back to front, right? Raising money is just fueling your business, and you want to raise the right sort of money at the right time, depending on your business model. I'm trying to, take a large chunk of a large market with profitable unit economics and a realistic chance of winning a large chunk of that market. That says raise as much as you can, quickly as you can. But in other business models, that's absolutely not true. So I wouldn't measure your own success by how much money you raise. That there's a time and place for different types of investment, and I'd think carefully about that before getting too preoccupied with it.
No, thanks, Matthew. Gav, do you want to add to that?
Yeah, very, very, very similar, I think. Certainly, setting out, working on that pitch and that messaging is absolutely key. And I've certainly have pitched what, in the early days, certainly pitched the message that I thought I was giving out, and having refined that and refined it, and then realized actually that's not truly who we are. And you make a lot of mistakes sometimes in these meetings, and you might put off someone who could have been an amazing investor just by erroring on that. So I pitch to anyone who'll listen now. I'll pitch, my wife has had many pitches, just so when she goes, yeah, I get that, I'm like, perfect, it's done. So that's been really, really good. I put a lot on getting outside help and advice. Picking the right advisors is very important. And also, I've actually been really lucky and been on Goldman Sachs 10,000 Small Businesses, NCSC course, which is done by Wayra. And they've really helped me with the messaging, because my GCSE in English didn't quite cut it. So it's one of those things that actually, as someone who's quite technical, messaging is something that I love doing, but I don't think I'm the best at it, but what I can do is talk passionately about it, and then someone can put that passion into some real true wording, which is better than what I could write. So that was really key. For me, I also think not only are you looking after your business when you're looking for funding, you are looking after you. What is your part going to be? And this is all about alignment to what Matthew was saying. It's like, important that that investor buys into not just the business, but you as an individual, because if you get that investment and then you find out later down the line they weren't really bought into you, you then become potentially, you know, surplus to requirements, and that's not a good feeling. So you've got to be really careful that someone wants to buy into not just the business idea, but you and your team, and that they understand that as well. So, you know, so set out your expectations of who you are and what you want out of this investment as an individual as well. You know, because that is also important to make sure that you're bought into exactly how it's going to go forward, which, you know, comes onto the partners and things.
No, I think it's a real challenge from an effort and an expertise perspective, isn't it? It needs to be practiced, refined, bounced off people, and in a way, it leads into one of the questions that we always get asked, which is, what's the appetite like out there for investment? You know, is there? It's all very well, I suppose, wanting to have 5, 6, 7, 8, 10 opportunities, but I'd be interested in the panel's view as to, you know, how much funding is out there, how accessible is it? You know, are there really only a handful of places you can go for the sorts of funding that we're talking about? Do you want to give us a view on that, Andy, to start with?
Yeah, it's actually quite positive at the moment. There's a lot of funds who raised money kind of pre-COVID or were closing funds pre-COVID. They've done a sensible thing in hang on to the money. Certainly in healthcare and tech, there's actually some sort of grown-up brokers and advisors get back in the market. You know, I had a couple of guys from Aquis or some people that do quite a bit on AIM actually chased me recently as well. So I think in general, things have really started to pick up, kind of post the hide the money under the mattress time, which was really sort of March, April, May last time, and look after the portfolio. We personally haven't done too bad, and we managed to raise money last year, which was a lot tougher. This year is already looking substantially better, and if you look across, certainly the sort of EIS funds, so the likes of us, Parkwalk, maybe even Deepbridge, but you know, into the VCT guys like Albion and sort of Amadeus and people like that, and even Maven and Mercia, you know, there's actually plenty of capital knocking around. The MPIF funds as well, I mean, they're still quite, you know, they're very, very early stage kind of stuff, but they've got a good sort of 30, 50, sort of 60 million knocking around still with another 12, 18 months to go. So I think as always, it's right opportunity, but I mean, Zickie's nodding ahead as well, because she's obviously got a lot of people chasing her to do work for her. But at the moment, anyway, I think it's actually quite buoyant.
Yeah, no, very positive, and I suppose that comes back to this message that both the companies have made about really thinking through the long-term partner you're getting into, isn't it? Rob, did you have anything you wanted to add on that?
Just reiterate, Andy's point, I think it's hugely positive, particularly for anything with a tech angle at the minute. COVID's kind of created, has polarized kind of appetite for certain sectors, and tech's one of those where there's been a massive increase in appetite for that, I suppose, because of the resilient nature of the business model. It's perceived as a safer haven for money, and you've got lots and lots of funds with lots of capital to deploy, chasing probably a smaller subset of businesses, given kind of leisure, travel, high street retail has taken a pretty big hit over the last 12 or 18 months, and there's not really a clear sign yet as to when those sectors will kind of bounce back. So I think it's hugely positive for anyone looking to raise funds, and we've seen that in processes and even off-market deals that we've been looking at. The terms that businesses and owners can get now, they're pushing hard. So there's more favourable terms, both in terms of the economics, but also the legals as well for businesses looking to raise capital, just because there is that wall of capital chasing fewer homes.
No, very interesting. Richard, you have a sort of probably a wider view of of tech with your access to the West Coast. Could you give us your thoughts on that?
Yeah, so speaking specifically to US numbers, 2020, you'd have thought things might have ground to a halt, but it's actually a record year for raising VC. So something like $77 billion was raised in the US VC market in 2020. But already 2020, and that was a record. 2021 is forecast to be 8% higher at about 83 billion. So there is that wall of capital that Rob mentioned there. And it's interesting sort of the makeup of those investors. I think there is quite a polarization between the large and the small. I won't focus on the large, the mega funds, the corporate venture capitalists. There was even a deal a couple of weeks ago in Sweden for Northvolt, which was one of the largest ever VC rounds at 2.8 billion. They're a Swedish battery manufacturer. That's the large end, so there is that abundance of capital, but perhaps more interesting, and again, still with the US bent, but at the smaller end, there was recent regulation in the US whereby crowdfunding limits have been increased to $5 million. And that's quite a decent sort of watermark, because the market does kind of categorize a Series A at being around about $5 million. So we've got almost like I said, democratization of investment here, whereby some of these smaller platforms are coming in to help Series A companies. So I think that's interesting. But from our point of view, we see the fundamentals as being robust. That abundance of capital, financial stimulus, low interest rates, and also that thirst for growth, which is arguably only found in the innovation economy. So we see the market, remaining robust, which has got to be a good thing.
Yeah, no, very much. That's very positive, isn't it? I mean, Zickie, Andy alluded to you being chased by funds. Are you just going to reinforce this message that there's plenty of capital out there?
Yeah, absolutely. That there's a lot of money coming in. There's a lot of syndicated rounds we're seeing quite a few much chunkier rounds as well going on. So in this last year, we've worked on an $80 million fundraise, $125 million fundraise, and a $40 million fundraise, all in the last 12 months. And it's great to hear that there is so much activity. Those fundraisers have all involved lots of different investors coming together, forming syndicates comprising a mix of VC, VCT, and corporates as well. But it's great to see that there is a lot of that going on. So certainly the sector focus is are really helping, technology, life science, and healthcare, and those are all sort of areas that have really excelled during the sort of pandemic and remote working environment. You've seen adoption of sort of tech and tech-enabled businesses, accelerated by 5 to 10 years in some sectors. So it's been absolutely incredible on some parts of the story. Obviously, there are other sectors that have struggled, and that's the sort of the reverse side of it. Yeah.
Just to remind the audience, we're at 1:15, so I've got a couple of questions, but if people have got some more questions they want to raise, then let me know. One thing in my mind then is what's the best way for someone in the audience wants to raise funds? There's this positive funding environment out there. From our panel, what's the best way effectively for you to be approached? Is it direct approaches? Is it through your accountant? Is it through another advisor? Is there any sort of, and I'm thinking about this consciously because you don't want to get it wrong. So any thoughts there? I'll almost open that up to the panel if anyone wants to answer that. So I need to pinpoint somebody. Andy, you look like you're engaged in that question. What do you think to that?
I have mixed views. Personally, there's an easy hierarchy. things that come referred to me by people I've probably invested with before on more of a kind of syndicated approach, I'll probably look at sooner. If Zickie sends me something, I'll have a look at it because it's pretty much been pre-qualified. I don't mind the kind of, the cold approach, as long as, I think we talked about it before, the homework's been done, so I'm not getting stuff that A is just not in our remit to invest in, be it quantum of cash or sector. And I'll let Rob and Richard speak for themselves as well, but please don't send me a 40-page Word document because I'll never read it. So it's going to be quick, relatively punchy to get my attention first, particularly when, the guys probably see similar numbers. We see about 1,000 opportunities a year, so it needs to be qualified enough for me to find the time. Really, I think it's just the easy steer for anybody.
Gav, just going back to a company perspective, because you were at some of this speaking to angels and what have you. Did you have any thoughts as to techniques you use to successfully get in front of this community?
Yeah, we started out with North Invest actually, and we sort of did a bit of pitching, and they introduced us to a couple of people, and actually I went to TechCrunch in Berlin, and I watched a workshop about messaging, and basically there was a few investors, and they all said, if you don't get me in 30 seconds, I'm not going to read your big stupid document. I spent literally all my waking hours refining the first punchy 1-2 into the story, and making sure I got that right.
It worked for us, Gav, anyway.
Yeah. So it was, to make sure that was the case. And interesting that how I got in touch with Praetura was, again, it was a network. It was somebody that I knew. We sat down for a coffee, and he said, I think Praetura is going to be absolutely perfect for you. And then obviously that 30-second pitch got the attention, and then from there on in, it was sort of plain sailing actually. A few bumps in the road with COVID-19, but actually that just the general approach to how that all went on as well was brilliant. So
Andy, I think you definitely owe Gav a couple of beers there. He's giving some good feedback. Matthew, I appreciate where you are in your growth is different, isn't it? You've got a sort of different audience, and I suppose it's any insights as to what you found successful at maybe earlier and then later on.
Yeah, definitely. So I think one of the key topics has already been covered by a couple of the other panelists, but make it part of your job and role to be a good person and make friends with lots of people, because the most effective thing for making these relationships is your network. If you want to know how to do it, ring some other CEO that's done it before. If you want to know who the 10 best investors in town are, you should be able to find that out from your network. So get busy on building a network. Just one other thing I'll say, at risk of losing some friends, either in the audience or possibly in the panel, in the UK, it's quite common, and I think Gav mentioned that he liked to go this way. So this is just a counter view, to use an advisor. And an advisor is like an estate agent sitting between the investors and the entrepreneurs, in many ways, in my opinion. But essentially what they're going to do is link you up, right? And if you know no one and you're sat on the world's best idea genuinely, then that could be an accelerant for you. And I did use an advisor at my A round, and it was an accelerant for me. After that, though, really, you should be able to do it yourself, in my opinion. And therefore, what a lot of people say the advisor is going to do for you is help you do the financials, help you do the deck, introduce you to the investors, and help you with the negotiation. Well, you'll know your financials better than them. No one can tell the story like you. The investor only wants to talk to the CEO when it comes to the investors. So what you end up doing is paying like £1 million for someone running a spreadsheet for you. That becomes different at a very late stage round, like north of 100 million or like an IPO. Obviously, then you need advisors, but that's only a counter view. That's just been my personal experience.
Yeah, no, I mean, I think Matthew, that's right, isn't it? It's firstly, I wish we did some of that work. That sounded like some decent returns for doing that, but we're a bit late to the game on that. But I think the point is a really valid one, isn't it? It's sort of the point I was asking Zickie about was, you know, how do you do that yourself? How do you find out where to go and who to speak to? And in a way, I think that part of it, you can get a bit of direction. You're not paying for that advice. That's your network, and it can be all sorts of different people in that network who get you there. Your point is actually once you're in front of somebody, you can tell your story as well as anybody else, I think, isn't it?
Yeah, I guess that's the crux of my point. Don't think that you can outsource that. You can't. And absolutely leverage your lawyers, your accountants, all that. Game on, definitely. And let's go back to the beginning of my point. You know, be a good person and make lots of friends. Like that's probably the most powerful way of getting networked. And at the beginning of my journey, I didn't know anyone anywhere, right? And so the advisor was useful there because they had the Rolodex of potential contacts. So it can be valuable. But it's just a counterpoint, particularly as you get later on.
The other point I would add, though, is also use your investors, because often they're obviously well steeped in the investment community, but they also used to working with investors at the next stage on as well, and so they can often help introduce you to other people that can help you on the next level of investment.
Yeah, I think that's a really good point, Zickie, and it's a point a number of the panel have made, isn't it? That actually, and also if one investor likes the look of you, but it's not quite ready for them, they will often have somebody that they speak to who will do it earlier or later, and that makes the process a lot easier, doesn't it? So a no isn't necessarily a no; it's a no for now, but you might well get some help along the way. So just conscious we're close to 1:30. We've had a question about COVID generally, and I know it was one that was raised previously as well. What impact has COVID had on the panel's investment approach? Again, anyone, is this particularly pertinent to any of the panel, or should we go for Richard? Do you have a view on that?
Yeah, I think we touched upon it. I mean, if you're working, our bank majors on tech and life sciences. There are sort of core sectors that we work within, and the PE and the VC community. So if you're solely in that space, you know, despite, and we shouldn't forget, you know, the human tragedy here, but these companies that we back have had a tailwind because of COVID. So we're kind of double busy at the moment. So yeah, it's hesitate to say it's been positive because of COVID, because that's not what we're trying to communicate, but it's been strong because of the pandemic.
No, interesting. I mean, I think that's exactly right, in that this is one of the reasons why tech is attracting so much interest at the moment, isn't it? Because it fits within some of the issues we've had. Would we have? We've got sort of 5 minutes from the panel. Should we just go for a their number one most important thought as regards raising funds for tech companies? Just go back to the order we started with. Matthew, could I ask you first?
Culture, shared values, shared vision. It's you're gonna, whoever you partner with is going to be with you for a long time. You need to trust each other and be pointing in the same direction.
Gav?
I think, you know, getting your 30 seconds right to make sure that someone gets excited about what you do, and have some optimistic realism about who you are, rather than, you know, crazy figures that you can't possibly sustain. I'd probably get critiqued for being too cautious, but, you know, I'm a Yorkshireman.
Andy?
Yeah, I mean, I think Matthew hit it on the head. It's about kind of cultural fit more than anything else, and that's being able to survive good times and bad. It's a partnership which is kind of long term, and a lot of companies when they approach me for funding, even if it's not a fit, one of the things I do talk to them quite a bit is do your homework, find the sort of people who you do want to work with for the long term, because it is a long term. And all I would say was, I was nodding my head when Matthew was talking about brokers and advisors. 100% agree. As an investor, I'm on a very similar page to him. Sometimes if you don't have a network early on and you're using a broker or an advisor, fine. As the businesses mature, you should be more than capable of doing it yourself and growing your own network.
Brilliant. Rob?
So slightly different tack, just to keep it interesting. I'd say expect to have your business and your business plan torn apart and the weaknesses kind of identified and questions asked around some of the areas you probably don't want the investor to focus on. That doesn't mean you've got a bad business or there's flaws in your business model. It's the risk-averse nature of our largely accountancy training and banking backgrounds that focus that lead us to focus on where the risks might lie, and then obviously being able to articulate where the opportunities lie that offset that risk. Because it's all about risk-reward balance in terms of making that investment decision within the partnership. And the partnership obviously is the first and foremost consideration for both parties. Is as much about the investor deciding can they work with the management team as it is a management team can they work with the investor, and both sides need to be comfortable, because it is a properly long-term relationship you're getting into bed with 5, 6, 7 years, 10 years in some cases, depending on which investor you might go with.
Yeah, no, thanks, Rob. Really good. Richard?
Just a simple one, really. Speak to portfolio companies. It's very important life after the deal. So, make sure you take your references and think about it carefully.
Zickie, final one for you before we wrap up.
Sure. For me, I would say don't underestimate the time it takes you to close the deal. So that's from the very beginning, making that initial contact with the investors, warming them up, getting them to commit to a term sheet, etc. And then the legal process. Don't leave it till the last minute when your back's against the wall and you're in a weaker position discussing things like valuation and stuff like that.
Just something I'd add and give advice: raise money when you don't need to raise money. Don't leave it to the point when you need money, because your negotiating position and probably the funders that were willing to speak to you at that point will be much reduced than if you come with a well-funded growth plan and you're looking to turbocharge that, as opposed to get the business out of a cash hole in 6 weeks' time.
Yeah, no, thanks, Rob. Brilliant. Well, look, that's almost we're almost on time. Just a thank you really to the panel for giving up their time to give us some of this insight. I think there's been some common themes in that, but some really interesting takeaways. So I hope that's been of interest to the audience. We have recorded this session, so I'm anticipating it will be available should someone want to recap or let someone else see it. But thank you very much, everybody. Really appreciated that, and good luck with your carrying on investing, and to the audience as well. Thank you.